I want to broaden this out a little bit because I had you on in April last year when you launched equity products. You have similar products, downside protection for the S&P 500. You have for the NASDAQ 100, for the Russell 2000 as well, that match the returns of the indexes up to a certain cap, but also provide downside protection as well. Here's the symbols, folks, that you can see here. And when they actually move here, and there's the rate you're capped at.
Yeah, so these are just a few of our offerings in the ETF space. You know, that capital protected ETF world had really not been captured until 2024 when we built the first 1-year principal protected ETFs. So we're seeing tremendous adoption there. We're seeing about 500–600 million move in just over the last few months here, and being able to do that now on Bitcoin, to be able to give you essentially Bitcoin with a safety net, and you can decide where that safety net sits. You can have 0% downside, 10% downside on February 4th, or 20% downside, and then your cap rate just goes up and up based off of the amount you put at risk. So again, you put no money at risk, 100% protection, you get about 11% cap. You put 10% at risk, 30%.
Of course, the problem with these products is we're in an up market. So, I mean, I would imagine you'd attract a lot more assets under management in a down market where people would suddenly panic.
It's a little counterintuitive. If you have capital protected growth, if that's your goal, getting 11% upside is the best power source. It's better than anything you're going to find in the market today. So you could put your safe money to Bitcoin now, which has been a little counterintuitive. Probably not something people would actually think of, but tying some safe money to the price of Bitcoin, getting
safe
good
money
upside.
in that it's 100% protected.
Yeah, you have no downside risk. That's right.
Yeah.
Where else can you get 11% upside with no downside?
Yeah. And Mike, the ETF world is seeing a flood of these derivative-based products, not just in crypto, but even in general. So some use buffer strategies. They use options to provide downside protection. Some use options to generate income, like JEPI. We've had them on. Some are leverage and inverse products that use derivatives to magnify returns. Well, generically, what's the appeal of all these products? Why is there a sudden explosion of them in the last year?
So the explosion occurred because of good regulation. You couldn't have done these 4 or 5 years ago. The second reason is people were doing these trades themselves, right? They were taking our ETFs that all these wonderful issuers are coming up with, and they're putting the options trades on. Guess what? They got to pay like 2 to 3 times as much for the margin, for the prime brokerage, for all of that stuff. Hiring professional managers to do it for you in a nice clean wrapper in a tax efficient way, it's just a much better way to go. And now you've got those kind of 3 core things that you mentioned. We can enhance returns through a form of leverage with options. We can create income like we do with YBIT on Bitcoin. We're generating almost a 70% yield, 68 to stay compliant, right? And then you can protect the buffer kind of things. Next, you'll see combinations, right? So we did one a couple weeks ago for a client where it's a basket of crypto companies. We're generating yield off of them, but we've also bought some puts to protect the overall portfolio.
And you watch flows very carefully. Have these products generated any significant assets? I mean, the Bitcoin ETFs have been a spectacular success. There's a really successful product in general, but have all of these, let's just call them various derivative products, generated a lot of assets under management?
Yeah, we were in the top, I think we were number 11 in flows last year, and we're only a $30 billion ETF platform. Of that, about $9 billion was in derivative-based product for YieldMax, Defiance, Nicholas Financial, SoFi. We have a product like this called Theta. So yes, these are generating significant interest, especially amongst the do-it-yourself investing crowd and those who are looking for income.
And this is going to continue, essentially.
I sure hope so.
It's going to get more and more complicated. The problem I have is who's buying these in general. I mean, I always say these things are successful if you can explain them to your mother. Buffered products get a little complicated. These products that you have get a little complicated. Sure. So who are you seeing buying them?
Yeah, I can tell you personally, my own parents own buffered type products, and it's easy to explain to them. You say you've got the upside exposure to a cap, a protection level, and a certain number of days that you have to hold to get there. It can be boiled down as simply as that. So, from a retiree perspective, there's 11,000 retirees entering the market every single day. It's the largest swath of people we've seen enter retirement in history. So we see the retirement side, folks that can't take on all of the volatility, financial advisors, turning to Bitcoin, we saw about 11% of advisors using Bitcoin products or Bitcoin exposure in 2023. That jumped to 22% in 24. Some good research from Verify there. And that's only going to continue. And so the Bitcoin products coming to market, the protected Bitcoin products, can give people an opportunity to access Bitcoin, but then put on some protection. Maybe you're pairing it with your spot Bitcoin exposure. This gives you a way to take off that tail risk and get good upside.
And I know you're on file with 2 other protected Bitcoin strategies, right? This one we're talking about is 100%, but you
That's
also
right.
have one that's coming out that's going to be 90%, and another one 80% protection over 1 year outcome. So I guess the lower the protection, the higher the caps will be?
You got it. Yeah, these would be called floor strategies. Oh, there we go.
There they are. Listen,
Yep,
right
so
there.
these are floor strategies. And so the first one, the 100%, would be a zero floor. So if you think about Bitcoin with a safety net, you can set that net at 0. You can set it at -10, set it at -20. Your cap rate goes from 10 to 12, all the way to 28 to 30, and then 50 to 55% upside. So now on February 4th, you'll be able to get 50 to 55% upside of Bitcoin, which is about the compound average growth rate over time, with 20% downside risk. And
Right.
so you're putting 0, 10, or 20% at risk.
I mean, the probability that Bitcoin's going to drop 80% seems a little remote to me. I mean, heaven knows.
I wouldn't go so far as to say that. I mean, it could. It has in the past.
Yeah.
I wouldn't necessarily expect it going forward, but yeah, maybe put 20% at risk.
50%, I mean, that seems like an interesting proposition for me. If I was a betting person, 50 to 55% upside, and you have 80% downside protection, you know, that gets a little.
I'm going to take that trade too.
What are the prices here?
They're all 69 basis points.
69 basis points.
Yeah, that's right.
Okay.
That's
So, I mean, for that kind of protection, that's relatively cheap. Mike, you were saying you could have done this before. You could have synthetically done this trade using options, but it would have been complicated and probably more expensive, right?
For an individual to do it
Yes.
using the options that have just recently been listed on these things, yeah, it would be very complicated. And then it changes. There's margin calls. I know there was a story about Interactive Brokers changing the margin rates for people playing with MicroStrategy. So like, give those headaches to the ETF issuers. Let us take care of those things. Let us use our scale with the market makers, with the APs, with the primes.
This is what ETFs are made for. Like this is what
Exactly.
it just makes the whole product easier and more manageable. With that said, it aids in the explosion of the options business. Now, some people think this is wonderful. Others are not so sure. It's hard to get your head around the derivatives industry and how big it is. We don't even know how big it is. It's
Yes,
in
and
the
now we have
trillions.
flex options, right, which are more tax efficient. We're able to actually redeem them in an ETF. So that's an even more powerful thing, right? If you do this yourself, you're definitely generating taxes.
So here's a question. I mean, is there a point at which these are not great products, or is there a point at which some of them could pose systemic risks? Remember the volatility products that blew up on us a few years ago? Nobody thought that was going to be a risk, and then out of nowhere, suddenly I had to explain what volatility products were and why this thing kind of went crazy on everybody.
Yeah,
is there any chance of this?
Leverage always has systemic risk, and if it gets too big, the street starts to pull back. We've seen it with some of the leverage products out there. The covered call and the buffer kind of concepts, using protection or sending income, I don't see systemic risk there, right? Those are actually lowering risk. The issue is really if the market loses liquidity in an individual name, but there's always liquidity at some price. That's the beauty of exchange traded products.
Yeah, and I think from Calamos' perspective, when you build an outcome-based solution, you want to build things on very liquid underlyings. So that's why you see outcome-based products on S&P, Russell, NASDAQ. Bitcoin, the liquidity shot through the roof almost overnight with the spot Bitcoin ETPs. $100 billion space, $2 to $5 billion traded every single day. And so now we're able to build risk-managed exposure on Bitcoin. It's also a reason we didn't go into the leverage side or build a 2x exposure to Bitcoin, things like that, because if Bitcoin falls 50%, that product could be down 100%, over that short time period. And so we want to focus on that risk management space, do it in a liquid way, and give people safer access.
I guess what's a little breathtaking to me is the Bitcoin products are sort of showing a natural evolution here that the equities products showed, but in a very compressed period of time.
Sure.
So we have plain vanilla Bitcoin ETFs. We had futures first, but we have plain vanilla. And now we're getting this explosion of derivative products around them, whereas with equities it happened much more slowly. I guess that's what's amazing to me, just how breathtaking.
Everything in crypto is that way, right? Like, you see all the memes, the good memes of somebody who's been in crypto for 6 months, and they look like Gary Busey after a mugshot, right? Everything in crypto just moves so much faster, and the ETF industry has helped bring that access to the traditional rails.
So now I see people pushing Solana or Ripple, which is used for basically money transfers, essentially, or stable coins like US dollar. And care to speculate on what might be the next hot thing? I know this is a losing proposition, but I'll give you a shot at it.
So I also manage Block, BLOK. I've been deep into this since 2017. I'm probably more of a Bitcoin maximalist. I believe in that chain. I understand the value of Ethereum. I understand the value of Solana and these things. A lot of this is stuff that may work, and if it does work, will get co-opted into the Bitcoin blockchain over time, is how I've always viewed it. So if you're not buying and learning these blockchains, then you're just speculating. I'm not really terribly interested.
But it always struck me that Bitcoin is a cryptocurrency running off the blockchain. Why isn't blockchain in general, the concept, the truly great thing to invest in? To me, that's what's amazing. I find DeFi and smart contracts to be, that really appeals to me. And here's something that is really broad. You can use it to send money, you can do real estate transfers, you could do stock settlement with smart contracts. I mean, that's very exciting to me, and yet Ethereum, as one version of a smart contract platform, has sort of had a moment and then been pretty slow for whatever reason. Maybe it's just because Bitcoin is sort of like moves quick. It's a get-rich-quick idea for a lot of people. They claim there's a store of value around it, but I don't know. To me, blockchain is, intellectually, I find blockchain more exciting than just Bitcoin.
I do as well. That's why I run Block, right? And we invest in a lot of things, and mostly companies, like you mentioned Ripple. We've owned SBI Holdings all the way through. They own Ripple, right? Like, so like, I'd rather own the picks and axes in any gold rush than the gold. And that's
Smart
where we
man.
focus.
Matt, what's Calamos going to do for the rest of the year? What kind of
to answer your question, I'm not a speculator. I'm a risk manager. We're a hedger, and so anything that's liquid, that has an options market, we're looking at building risk managed solutions for that. But there's got to be a really kind of safe number of filters before we'll bring something in an ETF, and so Bitcoin meets those filters. I agree with you. I think blockchain is a tremendously valuable asset, but in terms of delivering, a store of value and doing it in a risk-managed way, the protected Bitcoin ETFs.
You've been doing this a long time. Calamos is.
We've been managing risk for 50 years. I've been building options strategies for the last 10 to 12 years here. So there's a lot of there's a reason we've been around a long time.
Yeah. And of course, this is the future here. You see these literally in front of our eyes. From week to week, we see new products coming out in the crypto universe, and we'll be covering all of that on ETF Edge throughout 2025. That does it for this week's ETF Edge. My thanks to Matt and Mike, and we've asked Mike to stick around to provide his outlook on some of the broader trends in ETFs for 2025 coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.